Hello and welcome to IDFC First Bank presents Leaders of Tomorrow Season 11. I'm Sunanta Jayaseelan. On the show tonight, we are in conversation with two of the sharpest finance minds, posing questions on personal finance, on wealth, on making and managing money and all of that. Let me introduce my guests. My first guest tonight, MD and CEO of Sundaram Mutual Fund, Sunil Subramaniam. I'm also in conversation tonight with the founder CEO of Waterfield Advisors, Soumya Rajan. My first conversation with Sunil Subramaniam, I caught up with him earlier at our Chennai Springboard, an event where we invite entrepreneurs like yourself to come and ask questions to an expert. In this Springboard, he fielded questions on just portfolios, what an ideal portfolio should look like, rebalancing of portfolios. He spoke on IPOs. Should you as an entrepreneur look at going the IPO route and should you be investing in IPOs? He also took in a whole host of questions from our audience who attended our Chennai Springboard. Listen in. If you realize perhaps that one asset class has become stronger or weaker, asset reallocation, is there a thumb rule as to how you should be doing it? I know you mentioned 100 minus your age, but how do you go about really then rebalancing your portfolio in some sense?
So the first thing is that each asset class serves a different need. Like real estate serves first a shelter need and then a regular income need, right? Which is inflation hedged regular income, right? So your asset class, when you got to first decide three factors. One is you need a rainy day cover, which should be through bank savings accounts, liquid funds and the like. And typically a year's worth of expenses is what you should keep in your liquid. So you can touch it at any time, right? Suddenly you go through a tough time, nothing is there, that should be always there. So that's one, and that should be in a capital protection kind of a thing like savings accounts and liquid accounts. The second is a income generation scheme. Now, in an income generation is where you use fixed income. You have bank deposits, you have government's tax-free bonds, you have private sector fixed deposits, you have debt mutual funds, which today don't carry the tax benefit, but there are certain categories like a credit accrual fund, which could still give you, even with the same taxation, better return. Is that something the wealth managers can advise you there. So you say how much income apart from your business from which you're generating the income, right? Ideally, your business income, you should reinvest in your business. Because arguably your business will deliver much better than what any investment will deliver, because that's what the capital market is depending on. Whether you're listed or not, ultimately is that. So I would say keep your business income as reinvesting into your business and use the fixed income asset class to generate the cash flows that you need to run, right? And then you come to equities, and real estate also features in that as you get a commercial property, give it on a lease to an Amazon, then you're assured of the cash flow. The third aspect with equities is always your wealth creation. It's your postponed consumption, right? Which is where I use the thumb rule, say 100 minus 60. So then you can work out the bit. And the gold comes into that kind of an allocation because, like I said, gold is a currency hedge against the dollar. So there, I repeat what I said, right? Those should be clearly goal linked. So you'll have some goals in 5 years, some goals in 7 years, some in 10 years, some in 15 years. Earmark those based on your stage of life, your personal financial situation. Your wife also working, you're working. You have a daughter who's 10, do you want to see her get married at 25? You have a son, you want to see him go and educated. Daughter, you want to send abroad. So clarify those financial goals. That's where I said an advisor is absolutely critical, because you rather focus on your core competency in your business and get an advisor whose core competency is advising people to advise you on that.
You also said don't DIY, but AI technology is just making it so much easier in some sense to invest in the markets. And what's your advice really on that?
DIY makes it seamless to go and invest. It's also seamless to exit, but you don't know when to exit. When you're doing yourself a cot at your home, you get that kit and build the cot, it's done. But in this, you need DIY both at entry and exit, no? Right? And there, the ease of exit makes you take inopportune decisions inappropriately, because when you suddenly need money, that's easy, DIY, fat, redeem. Whereas that should not be redeemed, that should be left there, right? One. Second is, today the advisory world is also DIY. Today the world has become DIY. So it's not just because you go through a DIY. So each advisor will have their own app where you can execute this. You can, but with the help of advice you're doing. So DIY is an execution-friendly thing, right? But it's not an investment decision, cannot be instantaneous. It needs thought, it needs action. So I'm very much against DIY investment. The ones who should DIY are the retired people who want to speculate and have fun.
I would love to touch upon IPOs because of this audience of entrepreneurs that we have with us, both as an investment tool in some sense, putting your money in, plus is this a good time for small businesses which are saying, should I tap the capital markets? What's your advice?
So small businesses get their funding from venture capitalists, angel investors, private equity players, and finance their business, right? So they're not listed, they are unlisted, and they get the money, right? And then, because SEBI has the rule, right, 3 years of profits, blah, 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 before you can come. So then when you come to the market to do an IPO, right, when I as an investor, when I look at it, right, I clearly have 3 rules there. So first is, sometimes as a institutional investor, they give me a discount, so I'll buy it and sell it on listing just to make those profit gains, okay? Leave that aside. Otherwise, what I look for in investing in an IPO is that company raising capital to reinvest in its business, to grow its business, either by building fresh factories or by acquiring another company, right? Then my money is being put to better use in a much more profitable sense. Whereas if you have already raised private equity money and venture capital, and they want a takeout, and they are coming to the market to get their yield, what's he going to do? He is going to maximize his yield. But if you need money for your business to expand it, and you think the capital markets is a good place, that's the best place, because that's the most efficient pricing mechanism to get you your money, right? So I think that's the market is the best judge. Is today a right time to do? Okay, again, it's a greed versus need. So if you feel, like I said, because PLI schemes are there, there's enough opportunity. If you feel there's any opportunity, go hit the market today, right? But if you're wanting to make the maximum out of the market, right? You got to wait for the time that the market is in animal spirits, when there is irrational exuberance, and you will get, right? But that's a very selfish thing, right? It's not the ideal thing. But I can understand that if you have invested in your business and you want to take your money out at some time, sometimes that's pardonable and it's okay. But if that's the goal of your thing, then wait for some time. The markets will get into that territory in about a year's time, in my view. Okay? Sorry, very complicated answer to your question, but I just want to give you a clue into the type of thinking that you should do, rather than just give a, tick this box, do this now.
Fantastic. So one last question then. In your professional career, one piece of advice that you've received about investing or about approaching the markets that you want to leave us with, that's perhaps changed how you approach investing in the markets?
So that's the best piece of advice I got was when I was in American Express Bank in my earlier career, and there was an investment advisor from the Hong Kong who came down and gave us a lesson. And I followed that advice to this date. He said, when you buy a stock or a mutual fund or whatever investment, right, you made a decision. When you want to sell the stock, ignore the price that you bought. That is, separate the selling decision from the buying decision. Because most suboptimal decisions happen because, I bought it at 100 rupees. The price is now 60. Let it come back to 100. And most people behave like that. So anything that goes down, it comes back to the original price I bought. There's a relief. And I said, ignore it. But emotionally, that's the most difficult thing to do. And it needs that discipline. But that's what I have followed, right? Whenever I bought something, I've forgotten about the price I bought it. I always look at it saying, this is the cash flow I get from liquidating that. Can I today look at the future for the next 3 years or 5 years? And can I make a better return from that cash that I get? It might be a booking of 40% loss over the price that I bought it at. But that's irrelevant. And it's not easy. I know when I'm saying it, you'll realize it's not easy. Nobody likes to recognize losses, right? We always talk about our profits that we made in a very way, and the losses are already hidden away in your Godrej cupboard, right? But that means that you're continuing with that thing for a longer term. So separate the buying decision from the selling decision, and is one lesson which I've learned very early in my.
Mr. Subramaniam, for me personally, it has been very enriching. Thank you so much for your time. I'm going to take a quick break. When we come back, I'm in conversation with another expert from the finance space, Soumya Rajan of Waterfield Advisors, joining us in just a moment. Welcome back. You're with us here on IDFC First Bank presents Leaders of Tomorrow, Season 11. My second interview today with Soumya Rajan of Waterfield Advisors, speaking to us about being a woman in finance, talking to us about the importance of making and managing your wealth. She spoke to us on the sidelines of the Ladies Who Lead Conclave in Mumbai. Listen in. As a woman entrepreneur, you of course have first-hand experience when it comes to being an entrepreneur in the country. Is it difficult, and what are perhaps the biggest challenges or the difficulties you faced when it comes to doing business here as a woman entrepreneur?
I think it's particularly challenging to be a woman entrepreneur because everyone thinks that you are doing it as a kind of side business to either taking care of your home or just keeping yourself busy. I've always found that for people to believe that you are a woman entrepreneur that has intent, you need to make sure that you communicate that very effectively. And you need to communicate the fact that you're building a business where you are employing people, where you have an impact that you want to make, and you have a differentiated product or solution or strategy. So what is important and challenging for women is that while you may also have the idea, you may not always be able to access capital, because to scale a business, you need to be able to actually have the capital to scale the business. That is one of the things that I think we find quite challenging, and certainly I found challenging as a woman entrepreneur. Today I've raised 3 rounds of capital for Waterfield, but at each stage it was a difficult proposition because one, people didn't understand the business that I was building, and they found that, they always said Indians will not pay fees, so will you really have a business model and a revenue model? But for me, what I realized is that it's important to be able to handle those objections well. It means to be able to convince the other person that what you are building is really of value. And that's not easy. We have to be persuasive. We have to learn to accept the fact that when we raise capital, we may not appeal to everyone, but we will appeal to some people, and those are the ones who will be the backers of women entrepreneurs. What I'd love to see is more women investors, because they will understand what it is for a woman to actually raise capital. And if we see that ecosystem become much larger and become much wider and bigger, then I think the purpose of women entrepreneurs being able to scale their businesses will be something that we can look forward to.
Women perhaps lack financial discipline and literacy, Soumya, in the country. How can that be fixed? Are there any easy answers and easy solutions really to that?
I think financial well-being is a very important part of overall well-being, and it's important that women recognize that they do need to be financially literate. One of the statistics that I've often shared is that women outlive men. The growth of women's wealth over the next 5 years is going to be much, much faster than for men. Women are going to control almost about $30 trillion worth of financial assets by 2030. It means that women cannot ignore their relationship with money. They need to get more comfortable with it. One of the things we've tried to do at Waterfield is for women to feel more comfortable with that relationship. So we've created a program called Heritage, which is specifically for women professionals, women entrepreneurs, and women inheritors, where we say that there are 3 main pillars as women that you need to solve for your financial well-being. The first is around financial literacy. So it means that you may be financially independent, but if you don't know how to make an investment into equities, or you don't know how to make an investment into fixed income, or you don't understand what are the levers in terms of interest rates or ratios that are being thrown at you, then that's one thing that you need to fix. And that's what we're trying to do first through the program, which is to firstly allow for you to learn what are the ropes in terms of investments. The second is really in terms of networking. So our partnership with companies like Ladies Who Lead is really around the fact that networks are very, very important as you grow either your business or you just want a safe harbor and environment to be able to talk about issues which you may not be able to share with other individuals, whether it's your friends or your family. So having networks is very important for women. And the second pillar of our proposition is around that. The third is really around wealth with a purpose. What I found with women is that they want their wealth to have a meaning. It's not just about generating a certain return. It's also about that wealth that I am creating. Am I using it for my child's education? Am I using it to build a business or start a business? Am I using it for my retirement? Am I using it to have a philanthropic foundation? Women need a purpose, they need a goal. And that's why we think that it's very important that when you have any conversation around wealth and women, it needs to have a purpose. So Heritage is something that we've pioneered earlier this month. I hope that it will really help women out there to actually have a much, much better relationship with money and wealth. So Heritage is really trying to make sure that you get the best possible advice and that you're not caught off guard when you suddenly come into wealth. When we look at the fact that women outlive men, what I've seen at Waterfield is that we have so many clients that come to us who did not know how their spouses were managing the wealth, or they are going through a divorce, or they have a child with special needs. Now, these are very, very personal situations that we're hoping to solve for. I could, turn around and many people would say, could I have a robo-advisor or somebody who is, can I do it yourself kind of solution for these situations? The answer is no. And that is why we have the Heritage program, because life situations and life circumstances are unique. These are not things that you can just tick out of a box and say, I have a parameterized solution for it. That is what Heritage is trying to solve for. It wants to create that safe harbor where women can come to advisors like us and say, I have this problem, please help me solve it, and we are there for them. And the beauty, I think, of Heritage more than anything else is that 50% of Waterfielders are women, 33% of my senior leadership are women. We believe very strongly that we are able to identify that problems that women uniquely face, and we are there to help them because that is what we aspire to do.
If you were to design an ideal portfolio for an average client, what would really be some of the things that you would put into that? What would you advise that client?
So ultimately, we have very customized portfolios for every individual client, and I don't really believe in having a one-size-fits-all, largely because individual circumstances of different people is always different. But just in terms of broad headlines, I would really say that if you're looking at investing into equities, remember that you can lose all the money that you invest into equities. There is volatility which is associated with it. But on the flip side, if you stay invested for a long time, you could actually generate compounding effects when you invest into equities. Similarly, if you have a fixed income allocation, that allocation is your sleep well at night allocation. It should be something where you know that is accruing day after day, month after month, year after year, and is providing that cushion and that interest to you on a monthly, quarterly, or half-yearly or yearly basis. So it's important that when you're investing, you first understand what are the liquidity requirements you have, what are the expenses that you have, And then you set aside whatever is the rest of the capital that you've got in order to determine what goes into equities, what goes into fixed income. But the main thing is that never invest into any product that you don't understand. That's the fundamental thing that you need to look at when you're making any investments.
If you had to give advice to women who are at any stage of their life or are starting out, what advice would you give them?
So the best advice that I can give is that for anyone who's young and new to entrepreneurship, please be patient because you will not get success overnight. You will have to work very hard. You'll have to be a risk taker. You'll have to have enormous amount of self-belief. But you should also remember that where you are getting stuck, ask for help. Never feel that you are in this journey alone. There are many entrepreneurs who have trodden that path before. Reach out to them because they'll be more than willing to help you. All you need is a sound piece of advice at the right time to clear the doubts that you may have.
Out of time on tonight's conversation. If you have any feedback for us, do let us know. Our details coming up on your screens as we speak. Thanks for watching. Have a good night.